What is going on, investors? Hopefully you guys are doing well out there. The question I am constantly getting here on the comment section of the videos, but also on social media, Instagram, Twitter, those links are in the description below if you want to find me on there, is it time to buy the dip? Is it safe to buy the dip? If I'm buying the dip, what the heck am I buying? We'll answer some of those questions on today's show. First thing that I want to talk about, though, is tomorrow I'm going to be making an appearance on Thursday on the Trader Merlin show. And this is really the 1-year anniversary where I was on the show last year. And I talked about how ARKK, which is Cathie Wood's flagship fund, I made the argument that it could be a sinking ship. Now, so obviously I will be taking a very brief victory lap on this show, considering the value of that fund has absolutely collapsed over the past year. And a lot of it had to do with our fundamental analysis of a lot of the stocks that she owned inside there, including Palantir, Teladoc, Zoom Video, Skills. I mean, there's been a ton of companies she's invested on that we've absolutely blasted here on the channel from day one. Nothing personal against Cathie, nothing personal against those companies. This is business. It's not personal, but we did get this one right. We'll appear again on his show. So head on over to Trader Merlin show. Just search Google for Trader Merlin. Head on over, subscribe to his channel. He does a live show every week. I'll be on there tomorrow, obviously taking a brief victory lap, but probably talking about some of the opportunities that I am starting to see in this market. Now, first of all, the S&P 500, what I'm going to do is go through kind of the mega cap FAANG stocks, because as you guys know, my shopping list for stocks that I want to buy is probably going to be not a very large one. I started investing back in 1999. I survived that. I was here in 2008 and 2009. That's way back. I mean, that's way back on this S&P 500 chart. I have been through a lot of downswings. I was here back in March of last year, or 2 years ago, back during this big gigantic drop that we had March of 2020. I thought that was my once in a lifetime opportunity to really get stocks at a steep discount. Maybe it's starting to shape out more so in the most recent couple of months as we've seen the stock market pull back. The first thing to identify, though, is the S&P 500 is in a downward channel. And we've talked about this a lot of times on our channel here on YouTube. When you get in this channel, look, we'd expect a green candle to show up at some point. I'm on a daily chart. We'd expect maybe there'd be a good week here at some point. I tell you what, it's actually encouraging the fact that the markets are really just continuing to go straight down over the last couple of days. I actually really like that, because I actually think that's far less painful than putting up a green candle, not making a higher high, and then all of a sudden putting up a even deeper red candle. That's actually, in my opinion, what really shakes out retail are these downward channels. If we end up seeing that in the stock market, that could be a good thing, especially if you're the mindset of the buy and hold investor. If you're a retiree, if you're close to retirement, if you have funds in your Schwab account, your Fidelity account, wherever you're holding your money, and you're trying to buy a house, you're trying to pay for college, you're trying to buy a car, you're trying to do something specific with that money, you need to understand the stock market is in a downtrend. I would probably be looking to sell the green candle rips up to the top of this range. And if you're a buy and hold investor like myself, you're looking to really capitalize on these deeper pullbacks as well. As most of you guys know, you can probably tell that I'm not necessarily the youngest guy here on YouTube talking about stocks. I am 40 years old. I do have 2 kids. I am the only person earning income for my family at the current time. We are not in any financial difficulty, but I do play this conservative. So just keep that in mind as I run through this analysis. But if you're going to buy the dip, whether it's in this S&P 500 or more specifically the major FAANG stocks, which have just performed spectacularly up until more recently, you need to figure out how much money you want to invest in each individual stocks. And I would do that right now, okay? Before the emotion kicks in, when you actually have to put the trade in. If we have some big up day tomorrow or some big down day or a big week, one way or another, make those decisions right now. For example, if you want Apple and you want $1,000 into Apple, make that decision now. Microsoft, Google, decide how how much money you want in each individual stock. And you might not have that 1,000 now. You might be dripping it in over a couple of weeks or months. And actually, that's what I would personally recommend. I would buy in 10 to 20% increments. So in the case of Apple, maybe $100 to $200 per time. Wait a little bit, because like I talked about, when we come over here and look at Apple, this stock is in a pretty steep downtrend, just like all of these stocks. Now, when it comes to Facebook, some of you might be wondering, am I looking to get back into this stock? No, not really. My fundamental argument is this business has deteriorated. Here's the Q1 revenue growth. This is all the online advertisers out there. We've got the Trade Desk, we've got Snapchat, we've got Google, we got Pinterest, and we got Twitter. We've got their Q1 revenue growth is this first column. You see that Facebook actually brings up the rear at just 7% growth in their last reported quarter. And then we had Q2 projected growth, and look at where Facebook is, 2%. So the industry, and I would say the industry could be pegged by Google. They have a very mature product. They're still growing at 15%. That is why if I had a shopping list, I'd far prefer a stock like Google, considering Facebook's growth looks like, in my opinion, it's fallen off the table. We're in this downward channel with Facebook. Not necessarily a stock is on my watch list in terms of buying anytime soon. That is because the rest of these stocks, which I think are far better positioned in the longer term to survive and thrive, are pulling back almost a similar distance. Now I've got Apple here. I'm going to switch this to a monthly chart. And I do this every time, every big market decline, every time one of my stocks has declined, I always do this. Okay. What I've done here with Apple is I've done a very loose calculation of some of the big drops that we've seen with Apple stock over the last, we'll call it 10 to 15 years. So all the way back in 2008 to 2009, Apple stock dropped 61%. Back here in 2012, the stock actually dropped over 44% when they started hiking rates the first time. And we saw kind of that initial Fed action into the presidential elections. We saw Apple drop 32%. There was another drop here of about 40%. This was the first time they really started hiking rate. This was the Powell pivot that we saw. If you watched my video this weekend, I talked about how when and if the Fed changes policy, they'll do it eventually. Whether or not they do it in the short term or long run could be your signal to really go in on stocks. And we noticed back in March of 2020, like a lot of stocks, Apple went down 25%. More recently, though, the stock is still down just 20%. So we have a 25% drop, 39% drop, 32% drop, 44% drop, and a 61% drop over at Apple. So I think what you can say is the really, really bear case with Apple is it goes down another 40% and it meets the drop that it made back in the great financial crisis. Certainly, if you look at the macro environment, look at inflation, look where rates are going, look at the global conflict that you have over in Europe as well. Look, there's a lot of negative things. I think you could probably make that argument. Somewhere in between will be a 30 to 40% drop. That's still another 10 to 20% lower that Apple could potentially go. And so how does this relate to buying the dip? Is you want to say, could you handle another 20% drop on Apple? Since that looks like it would take us kind of in the midpoint of the big drops that this stock has seen over the last 15 years or so. If you can handle another 15 to 20% drop in your Apple shares and you've got a longer term view on this stock, well, I think you could press the buy button if you wanted to and just close your eyes for the next 4 or 5 months. If I were to do that, I would emphasize I would come in 10 to 20% increments on this one. So figure out how much you want to buy. If it's 10,000, 1,000, or 100, come in little increments, because you'd love if this stock does have that 40% drawdown, which is about average, again, for what we've seen over the last 15 years. When this stock switches momentum and it heads down, it goes down 39, 40% a lot of the times. You'd like to have plenty of ammunition left when it bottomed out there. Now, moving on to Amazon, similar type of drill with Amazon, far more volatile stock. Okay, the stock currently is down 43% from its highs. We had a drop back in the March lows. That was 37%. We had a 33% drop back here. We had another 30% drop, another 33% drop, and way back during the financial crisis, down 66%. So 43% drop for Amazon over the last couple of months, peak to trough, is actually a bigger than average drop than we've seen over the last several years. and it's starting to approach the great financial drop of over 65% on this stock. I tell you what, with Amazon, just from a technical perspective, the previous highs that we made back here in 2018 at about $2,000 per share seems to me like that could be an interesting area. That would be a 45% drop. Again, give or take 4 or 5% on these. I didn't draw them in maybe 100% accurately, but you get the idea that we have one of the biggest drops. In fact, we have the biggest drop we've seen on Amazon stock since the great financial crisis. If you're confident in Amazon's future, the fact we've got a $1 trillion valuation and certainly doing a conservative growth rate on their revenues, over the next 5 to 10 years, this company is likely to achieve over $1 trillion just in net sales. There's obviously some headwinds that could come into Amazon business that could impact that, but that is something to think about. Now, in terms of Nvidia, hello, I posted this on my Instagram and my Twitter today. The fact, I mean, this is just setting up perfectly. We've pulled all the way back into this box. Those of you that watch our FAANG stock recap show know I've said for months with Nvidia, once you got south of about $160 per share, that pulled it into a buy zone. And here we are sitting on its doorstep. We've made a 52% drop peak to trough on Nvidia. That is not necessarily that atypical for this stock. The big October 2018 drop took us down 58%. We had another 56% drop back in 2011, another gigantic drop during the great financial crisis, down over 80%. So big beta stocks, especially when you're talking about Amazon and Nvidia. If you really think this is the bottom of the market, these beta stocks certainly have the most upside, but they also have the most downside, considering this stock has dropped 52%. But I could see if we have another great financial crisis moment, this stock could easily go down another 30, 40, maybe even another 50% from where it is today. A lot of risk rewards with this one. You bet you on Nvidia, if this continues to trend down, it gets into my box, I will do exactly what I do here. I've taken profits on Nvidia already. I'm not in this name right now. I had a massive profit in this stock. I think I bought this back likely during this drop in 2019. I had a huge run up in this one, took profits in it, but I will get back in 10 to 20% increments when it comes to Nvidia. Now, Netflix is a no-touch stock for me. This looks really bad. I think all these other stocks have pulled back into ranges where they make them far more attractive. I don't have unlimited funds to invest in the stock market, so you got to draw the line at some point. Google, a stock I absolutely would love to own. You've got market-leading revenues. You've got 23% growth rate. Your competition over at Facebook's getting absolutely demolished, and your Q2 revenue growth is going to be 15%. While it's not as high as some of the high flyers like a Snapchat and a Trade Desk, they have far more profitable and far more levers that they can pull. They also control the Android operating system, which means they'll never kill off their own business on their own operating system. Not only that, they pay to be the exclusive search provider, at least the default search provider over at Apple, gives them a huge competitive advantage. Now, Google stock is down about 26% peak to trough, but look, we saw a 30% drop on this stock back in that March 2020 timeframe, but the stock actually doesn't do a lot of big down moves. We had a big down move back in 2009, 2010. We went down 30% during the great financial crisis, down 60%. So if you think there's going to be a great financial crisis type drawdown in the equity markets, and again, I could easily see how somebody can make that argument. Well, a Google stock has a long ways to go. This thing will probably go down another 20 to 30% at least. But if you believe that Google, under more normal financial conditions, maybe we don't get quite the great financial crisis moment, well, this stock can go down about 30%, and we're sitting here at 26. There's a target I have drawn out here, probably down here at about 30%. I think you get down about 30% on Google, I would likely step in on that stock as well. Moving on to Microsoft, this one peaked to trough this year to date, down about 26%. We went down about 21% back in 2019. Great financial crisis, down about 60%. So again, this sits somewhere in between kind of a normal pullback that we've seen with Microsoft. Anytime you've pulled back on this one 15, 20%, it has been an absolute stone cold buying opportunity. The only time it has not been that way is during the great financial crisis, down 60%. So if you think the great financial crisis is coming, actually the quote safer stocks probably have still a very long ways to go. But I think it's safe to say if you fall on the side that, oh, we're not going to have a great financial crisis, this this is something that's going to fall a little bit short of that, well, certainly Microsoft's pulling into the zone, 25, 30%. There's some areas that we have marked down here at about 40%, certainly would be kind of a Nvidia-like demand zone. Anywhere south of about 37, 40% zone on that one, I probably will step in pretty rapidly. Now, the last stock that I would definitely be looking to add during this time frame as well is a Tesla, and it's not doing anything really unfamiliar with this stock. Now, it's incredibly volatile. This stock has had many, many pops and drops, but it tends to do this. Like, it goes on these kind of rallies, and then it does a gap up, okay? And then it does the same thing, goes sideways for a while, has a big gap up, and I think with Tesla, what we're seeing is we're in for another kind of sideways consolidation mode. There's some demand for these shares down about $630 up to about $730, about where the shares are right now. You'd like to see that level hold, or the stock, quite frankly, to chop there, and then you're waiting for your next maybe Cybertruck moment, maybe announcing a new facility in India or whatever it might be that could then drive Tesla stock up even higher. I think Tesla will likely continue to make this kind of staircase formation as long as their business keeps maturing and moving along the way it is. Hopefully, you guys, this helps you a little bit. We are in the territory where a lot of these stocks over the past 10 years have actually been traditionally a very, very, very good buying opportunity. The outlier event is back in 2009, 2010, where you had the great financial crisis. Again, many economists are projecting that we reach that moment again, and it actually is an argument that makes a lot of sense. So if you are going to step back into this market, I would do it very gently, just understanding that the S&P 500 has made a very, very clear topping pattern and is now making a very, very clear and orderly downward channel. There's a lot of very, very negative stocks that are in this downward channel, including like a stock like Uber. You can look at stocks like Lyft. They get in this downward channel, and yes, another big, gigantic red candle can show up. We've seen this a number of different times with a lot of different stocks. I'm not trying to talk out of both sides of my mouth. I'm just talking you through what is going through my own mind as well. I'll certainly keep you updated here on the show. Check us out tomorrow on the Trader Merlin show, and then again Friday on our FAANG Stock Recap show. We'll see you all then. Good luck with your investments.